Hello and welcome back to Rev Real Estate School. I'm your host, Michael Montgomery, and today what we're talking about is how you can perfect your CMAs. Now, your CMAs can be such a great tool. Oftentimes, we just think about them as a way of pricing a home, but in fact, they're so much more than that. What they're doing is they're conveying trust, they're conveying knowledge, we're helping a seller understand something. And also, they can be used as a lead generation tool. So in this episode, what we're going to discuss are general CMA tactics that we can start implementing, also some errors that we tend to see when it comes to CMAs, and then finally, we're also going to talk about objections. Now, another thing you'll notice as we're going through this episode is we're sprinkling in certain scripts that you can use, certain lines that you can use when you are discussing CMAs with a seller. And so oftentimes when we're discussing CMAs, we're going to get resistance around pricing. We're going to get resistance around our methodology. And so throughout here, we have little scripts that you can use in order to better convey our messaging to sellers. So the first concept we have to be aware of. Oftentimes when agents go into a CMA, what they're doing is they're coming down to what they think a property will sell for. Instead of focusing on that, focus on buyers. Focus on how a home will be positioned in the eyes of a buyer. Think in terms of pricing a home for a buyer to write an offer on. Now, what this is doing, it's a very subtle shift. Now, instead of focusing on what the home is worth, what we're doing here is we're focusing on what a buyer wants. We're focusing on how we're positioning the home for a buyer. And what this will do is this is going to separate your CMA from other agent CMAs. Other agents will be coming in and saying, this is what your home will sell for. But what you're going to do is you're going to be talking about how this home is going to shine and how it's going to be positioned for buyers to actually write offers on this and for this home actually to transact on the open market. So it's a subtle shift, but what you'll notice when you start speaking in terms of buyers is sellers are not going to be as focused on exactly what they want for a home. Instead, they're going to be focused on what is a buyer willing to pay for my home. And so this shift in our language, as we're communicating our CMA, this doesn't necessarily mean we have to change our CMA process. It just means when we're communicating our CMA, we want to be discussing in terms of what buyers are willing to pay for certain things. And that will help sellers understand the value of their home. Now, what this actually does is it helps sellers get away from this concept of, I paid $10,000 for X. Now, we've heard that a million times, that a seller has paid a certain amount for an upgrade. However, that doesn't necessarily mean that a buyer is willing to pay for that on the open market. And so what we've done here is we've now taken the conversation away from what somebody has paid for something towards what somebody is willing to pay for it on the open market. And so this is an example of how we can start positioning our language in terms of how we are setting up a home to sell for a buyer. Now, a script that you can use here, and I love to use this script even before we kick off the CMA. Even when we're opening up the CMA and getting started, I like to say this right off the bat. And all I say is, regardless of market conditions, sellers always want a little bit more, and regardless of market conditions, buyers always want a little bit less. And so what we're doing in having that conversation as we're opening up the CMA is we're allowing there to be some differences here. Because we know the seller is always going to want a little bit more than what our CMA will actually net out. And a buyer is always going to want a property for less than what a seller wants for it. That generally speaking is how the market works. So by having this conversation up front, we've basically taken that off the table, because then at that point in time, the seller is going to come to us and the seller is going to say, yes, I want X, you're suggesting Y, a buyer might want a little bit less. And so they've already put into their mind that they're going to want a little bit more than what the home might already be worth. And so at this point in time, it's allowed us to have an open conversation around the value of the home instead of what the seller just wants for the home. Very powerful concept. So the next thing when we're jumping into the CMA is helping understand the difference between a list price and a sale price. And oftentimes as real estate agents, we get this. We get that a list price and a sale price aren't necessarily the same thing. But in fact, for a seller, they're oftentimes thinking about this a little bit differently. So a way that you can approach this is by letting sellers know that a list price in many ways is a marketing technique. A sale price is what a buyer is willing to pay for the property on the open market. And so just like a stock, and this is a script that you can use, just like a stock, if a stock is trading at $100, you can't sell that stock for $300. It just won't happen. And so the same goes for the CMA, and the same goes for the home on the open market. We can't command a higher price than what a buyer is willing to pay for that, just like a stock. So this is where we can come back to the fact that a seller and the listing agent will together come up with a marketing strategy. And part of that marketing strategy is the list price. But ultimately, the buyers in the open market are going to determine the ultimate value of the home. So we need to separate those two concepts. And the reason why this is powerful is because even in the face of underpricing a home, the market will bid it up. So just because you underprice it doesn't necessarily mean it's going to sell for below its value. It will sell for its value at the end of the day. And so what we're trying to communicate here is that regardless of where we list this, buyers are going to be the ultimate decision makers. However, list price is still very important because it's a marketing technique. And if we end up botching that and we end up pricing it for way too much, then buyers aren't going to look at it. Of course, the listing is going to become stale and it could sell for less. So this is a very powerful technique when we're kicking off the conversation to be letting them know that sellers typically want more, buyers typically want less. And a list price is a marketing strategy, and a sale price is the value that buyers are going to assign to it on the open market. Now, this is a very important concept, and one that we can use when discussing list price and sale price with sellers. So a script that you can use is simply letting them know that if we were to underprice this, buyers would bid it up. But if we overprice it, we may end up getting passed over by the market. And so what we're doing here is we're conveying the risk to overpricing. And we're letting them know there's less risk in underpricing. Now, that's not to say that we want to underprice a listing. We want them to make the decision that's best for them. That being said, we need to help differentiate the concept of a list price and a sale price for a seller. Next, let's discuss what actually goes into the presentation when we start discussing the CMA. Well, first off, what we want to do is we want to start high level. We want to zoom out and we want to discuss very, very briefly what's happening in the market at a national level. Now, this seems quite large and like we're zoomed out too far, but that's okay. What we really want them to understand are the general market conditions throughout a country. Now, that being said, everything is hyper-local. So all we're doing here is we're helping provide some context as to what's going on in the market. And then after that, we start to zoom in and we talk about what's going on in our city. And then we start to get into the community and the exact product type. Now, as I'm moving through this, I'm talking about the nation in 1 to 2 sentences. Same thing with the city. And then I'm spending a lot more time on the market conditions for their product type in their given community. Now, there's a couple of important reasons why we bring this up. And this moves into our next script. And our next script is simply saying that they are the boss, but we are the expert. So seller, you are the boss. You are going to call all the shots here. I'm the expert that's going to help uncover what's going on in the market so that you can make the best decision. And so by having a discussion around what's going on in the market and even zooming out and talking about the nation, this really helps solidify the fact that we are an expert and we are here to guide them through this. But it's important to understand, especially in the face of a market that can be declining, is to let them know that they are the boss. Because they do not want to be pressured into making any decision. And in fact, even when they're calling us, when we're coming through their home, when we're discussing pricing, oftentimes they have this underlying feeling that their real estate agent is going to try and pressure them into something. So we want to let them know right off the start that they are the boss and they are going to be the ones that make the calls. So when we're discussing the market and specifically discussing the market at a hyper-local level, we want to discuss not only where we are, but where we're going. And usually when we're looking at comps, we're looking at what's happened historically. Now, even historically could be a few days, but that being said, what are the trends that we're seeing? Because ultimately, we want sellers to know that we don't necessarily want to price this in such a way that we end up chasing the market down. So if the market is on the way down and there's downward pressure on prices, we need to price to where the market is and where it's going, not where it was. And so this is a very important concept. It's the concept behind catching a falling knife. And if the market is dropping, if we end up pricing a little bit above market, and then we end up chasing it down with price reductions, we could end up selling for significantly less than if we were to price it appropriately off the start. That's not to say that strategy doesn't work, and that's not to say that strategy isn't the right one for a given seller, but we do need to be mindful of the potential risks with that strategy. Now, when it comes to strategizing, We also want the seller to make the call here. So, a really good strategy that we can use is to ask them what's most important. Now, it seems quite simple, but by asking that question just open ended like that, we end up getting all sorts of different responses. And that's okay. We can start the conversation that way. But ultimately, we want it to come down to four things. And really, what a seller is mostly looking for is one of these four things. They're looking for money, they're looking for timing, they're looking for convenience, and they're looking for certainty. So all I ask of them, of these four things that most sellers are looking for, which one of these four is most important? Now you can see why this is very powerful, because depending on which one they select, that's going to inform our collective strategy and how we're going to approach this listing process. Now, if they are selecting money, then what we need to do is we need to be very focused on pricing appropriately, especially in the face of downward pressure on prices, because we don't want to risk further downward pressure, because that's going to cause us to take less money. Now, if they're selecting timing, then we want to work backwards from where they want to be and at what time. So if they need to be at a certain place at a certain time, we need to reverse engineer that. How long is it going to take to close? How long is the average days on market? What is our pricing strategy then? So we're working backwards from where they want to be and then to where we are now. And then finally, if they're choosing certainty or convenience, then really what we want to do is we want to be focused on a strategy that is aggressive. And the aggressive strategy is typically underpricing. And that way we have higher certainty. And then also we have higher convenience, because theoretically we come to the market underpriced for a short period of time. And then at that point in time, the home gets scooped up. So by choosing one of those four blocks, that's going to help us dictate how we want to communicate our suggested prices. Now, we just brought up an interesting word, and that is suggested. So I will never tell a seller, this is what you should list at. I will suggest. And I will say, the market is suggesting, the data is suggesting, my professional assessment, I am suggesting. And so I'm not saying this is what you need to list for, or this is what you should list for. Instead, we are suggesting. Okay, so now it comes time for us to start diving into the CMA. And at this point in time, I want to be very clear with the seller as to what is going to dictate the eventual selling price. Because there's really only a few things. And in fact, we can distill this down to two. Really what we have is we have competition. So competition and condition. Those two elements will truly determine what a buyer's willing to pay. If something has poor condition and there's lots of competition out there, it's probably going to sell for less. If there is poor condition, but there's nothing to compete with, well, it could end up selling for more. Now, we really need to think of these two things interacting together. So if their condition is really high and we want to help suggest to them how to get their condition to the highest possible level, and so for that reason, we can sell for a higher price. Now, we cannot control competition. The seller, and by our suggestion, can help control condition, but we cannot control competition. And nor should we ever claim to. And so the competition are the current active listings on the market, but also the competition we can think through the actual sales. So that's actually what has transacted. So we need to look at those, and we cannot control those. We cannot control the actives. We cannot control what something else sold for. We also, in a sense, can't control everything when it comes to condition. We can't necessarily make the home larger, or we can't necessarily make huge renovations because the ROI on that doesn't necessarily add up. But it's our job to help suggest to the seller how we can increase our condition. But then from there, we need to price in accordance with the competition. So when they understand these two levers, they'll very much start to understand how we're going to go about pricing a property and how they're going to make that decision. So now let's discuss actual comparables and how we're going to go about making adjustments. Now, when we're jumping into this, let's understand one thing, that there's actually no exact price for an adjustment. Now, oftentimes, newer agents very much struggle with this. In fact, every agent does. No agent, if you put 5, 10, 15 agents together and said, come up with a price for this property, they're all going to come up with the same price. Highly unlikely. And that's because there's ranges to everything. There's an art and there's a science to this whole process of the CMA. And so when we're thinking about this, when we're thinking about choosing our comparables, it becomes extremely important. And if we're choosing the wrong comparables, our numbers are going to be vastly off. But that being said, what can give us comfort is that there are ranges to every adjustment. Oftentimes this gives us fear. It gives us fear to think, why is there not just one number for a garage? Well, that's because there's a range. That number for a garage can vary between X price and Y price. And so oftentimes what this does is it makes us nervous that we're choosing the wrong price. Now, actually, this should give us confidence because it allows us to know that there's a range for a garage. And we know that there can be a certain price for a garage in one community and a certain price in another community. Now, when we're thinking through choosing comparables, this is extremely important concept. Extremely important. And one of the biggest mistakes that I see is when a new agent does a CMA, oftentimes what they'll do is they'll do a CMA and their range, let's say, is within 100,000 when they pick out their comparables. And then they finish doing their CMA and their range is now 150,000. So what happened here? Their adjustments theoretically increase their range. Now, what adjustment should do is take your $100,000 range and now bring that down to say 25,000. And so what we've done there is we've actually adjusted it down so that the range is no longer 100,000, it's within about 25,000. And that's because of our adjustments. If your adjustments are taking your range of 100,000 and making it 150, you've done something wrong. If it's going from 100 to 25, you're going in the right direction. Now, when it comes to choosing comparables, there's a vast array of different ways that we can go about doing this. But typically what we're looking for, the most recent comparables and the closest comparables. So I am not optimizing for the most number of comparables. And that's another mistake that agents will make. They want a ton of comparables. And yes, more comparables can give us more data to work with, but that also means that we have to make more adjustments. And so here's the magic. The more adjustments we need to make, the less confident we can be in our pricing. So if we are making adjustments and we have to adjust a home that is worth, say, 400,000, and we have to adjust that by 200,000, well, then we're going to have a very hard time backing that up because that's a huge adjustment. However, if we're just making $2,000 to $5,000 adjustments, and we're looking at $400,000 homes and we're looking at homes that sold for 410, that makes a lot more sense than looking at a home that sold for 600,000 and trying to adjust that down to 400. So I'm guessing this makes sense, but really what we're trying to drive home here is it's not necessarily about the number of comparables. Instead, what it's about is about choosing the closest comparables and the most recent. Now, here's a strategy that I will use. I will use a narrow set of comparables, 2, 3, 4, potentially, depending on the community and depending on the number of comparables that I have to choose from, but we'll choose that number in order to adjust to a general range. However, I do not want to discount the fact that their neighbor recently sold, although it's not comparable. I don't want to discount the fact because they're going to be thinking about that property that just sold across the street and why didn't I bring that one in? So this tends to be what I'll do, is I'll choose 3 or 4 comparables in order to actually come to a suggested range. However, I'll have another sheet with all of the comparables. So I'll have an extended list of comparables in the community, and this also will include a separate list that will have actives. So I'll have all of the sales as well as actives in a separate list, and then my CMA will only contain 3 or 4 comparables in order to get to that range. Now, this is a powerful concept. And it's because if you end up going into the home with 3 or 4 comparables and you miss the neighbor or you miss the one down the street, then they're going to think you didn't do your homework. When in fact you did, you just didn't select that one because it wasn't comparable. But from a seller's perspective, you should have their neighbor, or you should have that one across the street, even if it's not comparable. So basically what I'm doing here is I'm covering all the bases. Now, if I go into that house and I find out that that seller is very data-centric, very focused on the details, then we're going to open up those comparables and we're going to go into further detail as to why I maybe didn't select those ones in particular. And so we're really covering all of our bases here. We have all of the comparables, we have our 4 or 3, maybe there's a few more, maybe there's a few less, generally around that range in order to come to a range, but I haven't discounted the fact that the neighbors sold or another one sold or 3 homes down the street is also for sale as an active. Because actives are going to help us position our listing, but comparable sales are going to give us a suggested range. And so I really want to differentiate those two concepts for a seller. I want them to understand the actives will help us for positioning, but the sales will actually help us determine what do we think this home will eventually transact for. Now, the next thing that I also want to discuss as part of my CMA is this concept of depreciation. Now, the concept of depreciation can be challenging for us to really wrap our heads around, and especially for a seller. And depreciation tends to work, generally speaking. We have something and that will be worth less over time. So if I have a deck outside, 10 years later, that deck's not going to be worth what that deck was worth the day it was built. So that concept is extremely powerful and it helps the seller understand that even though they paid a certain price for something, that doesn't necessarily mean that's what a buyer is willing to pay. And it's the same concept of buying a used car. We've all heard this analogy of you drive the car off the lot, and the second you drive it off the lot, it's worth less. And that is the case. That is the case with most renovations out there, that we are doing renovations so that we can enjoy the property. Doesn't necessarily mean that we're going to do renovations and see an instant ROI for those. And so we need to differentiate that concept for sellers. And a great way of doing this is by explaining depreciation. And so in real estate, generally speaking, the house itself, the product itself depreciates, right? Because over time, the home gets older, it depreciates. But the land itself is what appreciates. And so really helping them understand that the home is a depreciating asset, but the land is an appreciating asset can help them start to understand where these comparables are coming from. And so when they come to me and they say that they just put in new flooring or they put in new flooring a few years ago, and this is what it cost, and then I have to have a discussion with them around, that's great. This is actually going to help your home sell for more. I'm going to be very positive about the upgrades that they've done. I'm going to say, this is going to help your home sell for more. This is going to help differentiate your home versus the next one that comes up. Ultimately, we may not get the $10,000 back that we put into it, but hopefully you got some enjoyment out of it. And yes, this will help your home sell. So I'm never speaking in terms of how this will not help their home sell. When they put effort and they put money into their home, I'm going to credit them for that. I'm going to be excited. I'm going to say, that's great. That's really exciting. And it truly will help differentiate their home and help position their home to sell for more. They may just not get that exact number that they were thinking about. And so I want to be enthusiastic about the upgrades that they've made, but I also need to be realistic. And I don't want them to think that they're going to get a number just because they paid a certain amount or they think something's worth a certain amount. Now, regardless of how clear we were with our communication as we're working through our CMA, we're still going to get objections. We're still going to have sellers object to our pricing. And so we have to be prepared for that. And if we did a good job of explaining our CMA and we went through a lot of these communication tactics, then by the time we get to this suggested range, at this point in time, oftentimes all the hard work's already done. We've explained our methodology and how we've gotten there. And that is key. The methodology of how we got there is key. The actual number is important to the seller. Yes, 100%. But we have to explain how we arrived at a certain number and the logic behind it. And if they're agreeing with the logic as we're moving through the CMA, then theoretically the suggested range should be okay with them. Now, that's not to say it always is, and we will get objections. So how do we go about handling some of these? Well, there's a few strategies, and one of the first ones is risk versus reward. Now, when we are getting objections around the CMA, we have to be comfortable with that as agents. Now, with that being said, we also need to communicate to them the risk versus the reward. And so if a seller was to say to me, if we're thinking about this home that should be listed around 400, but the seller says, no, we want to try 450, that's perfectly fine. What I'm going to say to the seller, that's perfectly fine. We can definitely do that. Let's look at the risks versus the rewards. And then from here, we can jump into how this is going to work. So if we are going to overprice, what we are hopefully trying to get is a higher potential number. But what we're going to risk is we're going to be on the market for potentially a longer period of time. And we know that buyer interest will drop off over time, and we could eventually end up selling for less than what we're discussing right now. So ultimately, we have to be comfortable with that risk. The reward is, yes, we might be a needle in a haystack. They might find that needle in a haystack. We might be that one house that this buyer's been looking for, and they're willing to pay over the eventual value of the home because they love it so much. Yes, that is the potential reward. But the risk is that that buyer does not exist right now and that we could end up reducing, spending more time on market and end up selling for less. So are we comfortable with that risk? Now you'll see what I did here. I didn't actually tell the seller to price it lower. I said, if you want to price it higher, that's fine. And again, I'm behind you. I'm here to take care of you. However, if you make that decision, this is the risk that we run. And using this risk-reward framework is very powerful to help sellers understand the risks of overpricing. Now, many of us know this. Many of us as agents know this, that the longer it's going to sit on the market, the less it's going to potentially sell for because that initial interest will drop off. So another way that I tend to explain this is I say that there's a pool of buyers right now. There's a pool of buyers looking for homes. And if we come to the market and we end up being discounted because we're overpriced and buyers say, nah, we move on to the next one, then we've missed this current pool of buyers. And then as we reduce, some of them might start to look at us, but the initial excitement will be gone. And so we will end up missing that initial excitement. With that being said, if there's one person in that pool of buyers who's willing to pay a little higher, then we may get them. But if not, then we risk losing this big pool of buyers. We risk losing their interest because it will start to drop over time. And you can even highlight this with data. So ultimately, sellers will make decisions based out of emotion, but then they're going to defend it with data. So we do need to build some data into our discussion. And there is some data from Zillow stating that if the home comes to the market, usually within the first few weeks, it'll sell within 1% of the asking price. If it sits for 2 to 3 months, it's going to be within 5%. And if it's over 4 months, then we're looking at 10 to 12%. And so over time, these properties are going to go for less than their asking price, regardless of if they reduced. So this is an interesting stat. So if we come back to our $400,000 example, and we think that potentially it will sell for around 400, we list at 450, and then we eventually come down to 400. If we are on the market for 6 months, then we're still going to have to expect about a 10 to 12% drop from that 400,000 because we've been on the market for 6 months. And so helping sellers understand that risk too. Again, we're coming back to risk versus reward. And they are the boss, we are the expert. Now, finally, when we are handling these sort of objections, what I find to be extremely powerful are analogies. And the reason for that is it actually takes the emphasis away from the home. And sellers have a lot of emotion tied into their home. They've put a lot of equity, they put a lot of effort into their home. And so if we come in and we discount that work that they've done, they're going to feel insulted. And I never want them to feel insulted. Sellers do amazing work to their homes. And sellers want a higher number for their homes, and I understand that, and I want to be empathetic to that. But ultimately, we need to have them think about this logically. And one of the best ways to do this is by way of analogy, because now they're not focused on the home. So we've already brought up a few of these actually in our scripting. And one is that if a stock is worth $100 and is trading at $100, we can't necessarily sell that for $300 today. It just won't happen. And we used a similar analogy when it came to a used car and driving a car off the lot. Now it becomes used and now it's instantly worth less than it was before we drove it off the lot. And that's the same thing when it comes to upgrades in homes. And so by using analogies, we're helping sellers frame this so they're not thinking about their own house, but they're thinking about the concept. They're thinking about the concept of an overpriced listing, whether that be a stock or whether that be a house. And then the same thing goes with a car. We're helping them understand the nature of depreciation and how the car will depreciate and the house will depreciate. However, we're not saying their home has depreciated. We're also not saying their home isn't worth more. We're just putting this in terms of something different, which helps them understand it and bring it back to the big picture of their house. So use these techniques, use these communication techniques when you're thinking through how you're going to go about approaching the CMA with the seller. Because there's a million different ways that we can look at valuations of a property. However, if we don't have the communication down, then we're really not going to get anywhere. And understand that when it comes to pricing, there are going to be ranges. We always want to think in ranges. We never want to think in terms of absolutes. And that's why when it comes to a CMA, I will never say the home is worth a certain price. I will always provide ranges. Now, what are those ranges? My ranges tend to be 3 different ranges. They're aspirational, market range, and aggressive. And so our aspirational range is that higher range, the range where we could see it trading for that, but it's a little bit less likely. We don't want to be overpriced though. Aspirational and overpricing are 2 different things. Aspirational is the higher end of the range, and then market tends to be that middle range, and then aggressive is towards the lower end of the range. So aspirational is not above the range. Instead, what that is, it's the higher elements of the range, and then the mid range is the market, and then the lower range is the aggressive. And so here we've presented options for the seller. Thank you very much for watching or listening to this episode. Remember, you can reach out anytime. I'm on Instagram at the.michael.montgomery or head over to revrealestateschool.com. Thanks again, and we'll see you in the next lesson.